Okay, we're going to start today with the homepage of Yahoo Finance. Okay, we have a stock market that's kind of sideways, that's break even for today. If you look at you can see on Yahoo Finance, we started up early and now we're kind of drifting downwards. And you can see that kind of corresponds with the US Treasury. As the US Treasury has gone up today, it started lower and now it's starting to um, to go up in yield. Um, that inverse correlation is why the stock market seems to be going down today. And we have, if we look at okay, on Fridays, where this is Friday, on Fridays, a lot of traders like to take profits before the weekend. They don't like to hold inventory. That's one thing. Okay, right now um, you see, we're right before a holiday, the holiday of Labor Day on Monday. So usually the stock market goes up right before the holiday, but doesn't work all the time. Um, but September is one of the worst months of the year. So um, we're in an overbought condition and we're going into one of the worst months of the year. Okay, we had let me see, hold on. We had a PCE. That is the Fed's preferred inflation gauge, and that came in as expected. So there wasn't any surprise there. But the yield for the 10-year went up as soon as that print came up. So, but that means that the Fed's probably going to still reduce interest rates at the next meeting. Now, what we're going to do is we're going to go over some of our talking points. Let's look at the S&P 500 and the trend lines. You can see that we are overbought. We've been overbought for about a week and a half now. So we're overbought. We're going into one of the worst months of the year. So there's a very, very good chance we're going to drift downward towards this part of our downward channel. So one thing I did add this week is I added the 150-day moving average. There's a guy named Carter Braxtonworth that says that's more important than the 200-day moving average. And we can see that a lot of times, like in some of the charts we'll be going over today, that 150-day seems to be a level of support for a lot of the stocks and indexes we're following. So you can see the S&P hit the 150-day moving average on August 5th when there was a big crash. So we're going to follow that 150-day moving average as the bottom, a form of support for the stock market and our stocks. And it's the green line. I've added it, the green line right there. All right, so we have a meeting for the Fed in the middle of September, and there's not really much else going on. We're going to probably have a rate cut in September, and then we have a November meeting, and then we have a December meeting where they're probably going to be quarter point rate cuts. So, but we don't have earnings for another 3 months. So there's a time in September and October when there's basically not a whole lot of news. And that's why stocks drift around September. All right, let's look what else is going on. We have like a pretty unchanged U.S. Treasuries. They're up after today's move. So we can't really say much about that. Let me see. The S&P is 76% of the S&P stocks are above their 200-day moving average. That means we're gaining momentum. We have some bullish, and a lot of people think the market's going to go up. That is basically the time to sell or don't buy. And okay, so our themes from the beginning of the year, let me see. Reversion to the mean, the healthcare, telecom, financials, and utilities are definitely outperforming now. They are doing much better than they did last year. And the let me see. And the AI theme is and the weight loss theme are doing good for our stocks. Let's look at the average monthly returns. September is one of the worst months. So that's why I have it red in the calendar. We're expecting a 0.7% to maybe 1% decrease in the S&P this month. Okay, stochastics, we already talked about this. It's overbought. We have a little bit of excitement for a Labor Day vacation. But other than that, we're probably going to be drifting down towards this bottom part of the range in September. We are above most of our moving averages, the 200-day, the 150-day, and the 50-day moving average. So that is a sign that we're going to keep progressing upward to higher highs and higher lows. But you have to expect the stock market to go down before it goes up. All right. So we have an inverse correlation. We had a 1-for-1 correlation, a perfect correlation between the Treasury rates and the S&P for just a small amount of time during that correction in August. But we're back to an inverse correlation of U.S. Treasury yield and the S&P 500. So just like today, when the yield is going up, the S&P is going down. The U.S. Treasury, the same situation, the 2-year. Now, none of our major variables are going up a lot or down a lot. There's a lot of unchanged. The dollar index is unchanged. Oil is going up a little bit, but it's been going back and forth between 76 and 73 for a couple of weeks now. So we don't have a whole lot of information about that'll affect the stocks we're watching right now in these variables. US dollar is still going down. And fear greed index. Investors are greedy now. So last week they were neutral. We've been going from extreme fear to fear, neutral to greedy. And this is the time that you want to either sell or take a profit. I'm actually taking a little bit of time right now to convert some of my 401k to Roth, because sometimes whenever you do a conversion, it's good to do some of that whenever you have the stock market at highs. Okay, let's look at the AAII investment survey. American Association of Individual Investors are really bullish. That's a contrary sign. So when they're bullish, it's time to take caution and take some profits off the table. Let's see. The VIX is going down. We had a big spike August 5th with the yen carry trade scare, but everything seems to be back to normal, and investors are complacent. That's basically the time when you have to be very cautious. All right, and the investor emotional graph, we are greedy. So we have a lot of emotions. We can't miss out. We have the AI news on the front page. And so right now we're greedy. This is the time you take profits. when everyone else is greedy. And Warren Buffett is basically taking profits right now. He has a lot of cash. He's waiting for the capitulation to come whenever that is. We have a couple of things that could lead to a capitulation, a crash in the stock market. Um, Possible um, reason is AI stock bubble bursts. We had a little bit of hints that there was an AI company, Supermicro, that came out this week. There was a short seller that said the accounting was bad at Supermicro, and that's one of the biggest AI darlings, and that went down a lot. And that could be the beginning. Whenever you see one problem, there's probably other ones around the corner. So there could be an unwind of the AI bubble. I don't know, but we have to be ready for that. Um, we have to also watch signs the economy is going into a recession. Right now, there is no signs of that. Seems like we have pretty decent job market and we have a decent economy. But next week there's going to be a job report, and if it shows that there's some kind of problems with jobs, that could lead to possible recession fears. Okay, earnings do not meet expectations. We don't have to worry about that because we don't have earnings for another 2 months. The last of the earnings were this week, basically. And that's it. All right, so okay, so we've been reviewing the worst to first since the beginning of the year. Um, the ones that did the sectors that did worst last year are super turning around, and they're becoming very good investments this year. We have healthcare up 14%, energy up 8%, consumer staples up 15, and utilities up 19%. So there's a total flip for these sectors from last year to this year. So that worked. And IT is still outperforming. So that was unexpected, but they are the most profitable sector. Okay, so our theme from beginning of the year, losers of last year will be winners of this year. That's true. But the winners of last year are still winners of this year. Let me see. All right, so we're still watching utilities for the AI disruption. That was unexpected. We have cyber security firms. We're following those, and demand for electricity and building out the data centers are themes that are high growth that we're following. And of course, we're following the weight loss drugs. All right, so I wanted to review this. This is the business cycle for this year. Right now, we're currently in the late cycle. So if we look at our graph, you start with a contraction, go to expansion, and then recovery. We're currently in this, okay, in the first part of the year, we were in the recession part, which is right here. And during that time, you had consumer staples, healthcare do the best, and utilities do the best. The second quarter and the third quarter, we're in expansion, and that is the late economic phase. So late, you expect real estate, consumer staples, energy, and utilities to do good. And let me see, Q3, we're going to start the mid cycle, which is Q4. We're going into this. Infotech is going to outperform communication services. Okay, so these two are expected in the next month to outperform. So we'll keep track of this. This is a new little chart that I found on Fidelity. We'll see if it works. But in next year, this is 2025, we expect to be in the early phase. So quarter four will be in this phase. And then we'll be in the early phase. And then the financials, real estate, infotech, industrials, and materials will do outperform. All right, so we're going to keep track of that as we go. Let's look at some of these sectors that are going up and down today. Okay, the ones that are doing the worst are gold, oil, and biotech. The ones doing the best are semiconductors, technology, consumer discretionary, and staples. And financials. Okay. But semiconductors are doing the best. Let's look at the market movers, the ones doing the best today. I'm not sure why Intel is up a lot. They basically cratered from the beginning of the year, and this could be a dead cat bounce. I don't know. We have a lot of oil companies. Valero, Phillips, 66, Marathon Petroleum up 2 or 3%. Wow. Wonder why. Um, United Airlines, CrowdStrike. Okay. One's doing the worst. Ulta Beauty had a bad earnings report. This is one that was blessed by Warren Buffett. So you can't necessarily buy blindly anything that Warren Buffett's company buys. Um, so it's going down 5% today. So that was a bad earnings report. We had Supermicro with that report. The company shorting the stock and saying bad things about their accounting. That's why that's down. And let me see. I'm not sure why oil was up today. Let's look at the oil. The price of oil is down 3%. Why would oil companies be up when the price of oil is down? I don't know. Usually, you would see a huge number of stocks in the red that are oil companies if you have negative 3% oil change. Okay, well, that's something we don't understand. Okay, NASDAQ. We see a lot of companies involving build out of the data centers, AI related. So we have MongoDB. They're involved with that. Marvel Technology, they're provider of technology for, I think it's building semiconductors and just parts for companies. Intel, I'm not sure why. Broadcom, they make they do a lot of software, VMware for the data center. So a lot of these are cybersecurity for data center. We have Global Foundries making chips. Okay, so these all kind of revolve around, maybe Intel's going up a lot and a lot of these go up with it. The ones going down the most, we already talked about Supermicro, Grail, don't know. Some oil companies could be going down because of the price of oil. And that's all I can see from that. All right, that was a good little excursion. Let's go back to our meeting notes. Okay, let's look at our top picks from Dan Niles. We review this every week just to see if his theories come to life. And yes, Amazon is up 19%, Meta is up 46%, Texas Instrument is now up 26%. XBI is also up. This is the biotech ETF, the small caps. They're up 13%, and KWeb is up 8%. So a lot of these were contrary picks. So KWeb, for instance, was in a downtrend forever, and no one liked it. So this was a contrary, going against the grain pick. So was the XBI. It's been outperforming for 3 years, and he says it's about time for it to perform again. Same thing with Texas Instruments. So his theory for Meta was that we have a political um, spending for ads, and same thing with Amazon. Um, and that's turning out to be one of the best picks this year, actually. Okay, so for this week, this is probably the last big week of earnings of the quarter. So the big news this week was from Dell and from NVIDIA and from CrowdStrike. We had NVIDIA report better than expected earnings, but they didn't meet the expectations of the whisper numbers. It wasn't, so they sold off a little bit. Right now, in Dell, actually, they reported they have a they grew 80% in their data center. So their AI chip data center part of their business is growing a lot. Um, we're going to go over Dell a little bit later on today because I just thought it'd be interesting to go over the numbers. One thing people don't make a big deal about, which I think is a big deal, is that 70% of PCs in the world will not support the latest version of Windows 11 because hardware. They don't support the certain hardware for 70%. So there could be a cycle of 70% of users in the world have to buy new laptops or desktops in the coming year. That is a huge cycle. Um, and no one's talking about it. I'm surprised. So you're going to have either a lot of computers running Windows 10 that never get updates, or they buy a new computer. So not only Dell will benefit from this, you have um, HP and other manufacturers of computers that will do good. So that's not in their numbers. We'll look at Dell's numbers now, but I'm surprised they don't have like a big sales um, estimate for the next coming year because of that. Okay, so we're going to look at some charts of interest. One is Apple. You can see that this has um, a lot of momentum right now. They have a September 10th release of their iPhone 16. They're expecting there to be a lot of people upgrading because it has AI, artificial intelligence, in the phone. So that could make a lot of people upgrade. But you can see it's in an uptrend right now. It's above all of its moving averages. You can see this is the 50-day moving average, the 200 and the 150-day moving average. So this has more momentum than any stock in the last month or two. It's been super on fire. This stock is Visa. You can see that it was in a little downtrend right here, but you can see that a lot of let's look at our stochastics for the XLF. You can see that a lot of the financials are in an uptrend, and Visa and MasterCard are both, they've been in this little downtrend here for a while. But Visa just broke out of that downtrend and started this little uptrend. So let's see if it gets out of that. Visa and MasterCard are growing between 15 and 20% a year due to more usage of credit cards. They're basically a toll collector. So they basically try to get as many people to use their credit cards around the world. And most people around the world are still using cash for transactions. So as people start using more cards around the world, um, they grow. So that's interesting. Um, Berkshire Hathaway, you can see it's at the top of its range right now, but this has like a lot of momentum. It's the top of its range it's ever bought. But you can see that it has one of the strongest patterns in the stock market right now. And it reached $1 trillion in value this week. And it's the only non-tech stock to do that. And it's been basically compounding at 20% a year um, for the past, I mean, forever. And it has a lot of cash right now. As soon as we have our next correction, I'm sure they're going to put like this $350 billion worth of cash to work. But Warren Buffett's really good at timing things. And if he has a lot of cash um, on the sidelines, he must know something that we don't. Eli Lilly continues its uptrend in a lot of momentum with this stock. It's overbought and it's at the top of its range, so it's not a good time to buy that one. Okay, so there was a report this week on NVIDIA. They said it's in the report they mentioned that their revenue is jumping 122% year over year. Let me see. The revenue center, wait, their data center revenue topped out at 26 billion, and that's 154 year over year increase. So it's growing, and they beat their estimates. And we had all these nice people here from these different places saying, they're going to raise their estimates, and they say we continue to believe in the growth opportunity. They're dominating with 80% share in the AI deployments. So every one of these people here highlighted um, basically say they have a strong quarter and they have a lot of momentum, and they're upgrading their price targets. But the stock sold off because they didn't meet the pristine estimates that they that they were growing last time and what they were expected. So they're basically what I did is I thought it would be interesting to go over their numbers just to check up on them. From this year to next year, we're expected to grow 217%. That is pretty outrageously good. But the issue is after this year to next year, we have a 40% growth, 17% growth, and 10% growth. So that is probably why the stock is trading at like a PE of around 44, because people are looking to next year's growth, which is 40. And then years after that, they're going to be weakening their growth from set to 17 to 10. So it's kind of tricky. They haven't predicted this accurately before, because last year at this time, I remember we were looking, they were saying 40% growth for this year, but it turned out to be 122%. So, but this is a very strong company. They beat their estimates. You can see this green means they've beat, and that's 7 quarters in a row. So that's a very strong company. But you can see that the earnings are growing like this. So a lot of times stocks charts follow the earnings. So we expect it to go up and down, up and down, up and down around this earnings bars. So, but the one thing to think about with the semiconductors, there are times when companies order too much and then there's no demand. So you have the situation where there's feast and famine. You see how this was growing, and all of a sudden they triple ordered, they quadruple ordered. Now there's no demand for a little bit. So you have to be willing, when you're owning the stock, to sit through these times where there's no demand and people have ordered more than they need and they got to digest. So this could be like a digesting time right now. We don't know, but it seems like they're growing at 44% continuously over time. So that's why they have a PE of 44. So it seems like it's fully valued right now. Because we have this 40% estimate for next year. So let's see if it's that's going to turn out that way. There's another article here that says Dell soaring on Q2 earnings beat. server sales growth. So Dell, you can see it. There was a huge drop from 160 to like 102 recently. And it got to a point where it was super oversold. And sometimes it's whenever that happens, I start looking at it as possible stock to buy whenever it sells off in a major way like that. So we know we have that catalyst of 70% of PCs in the world will be running a computer that doesn't have a current operating system on it that works. I mean, current operating system, because now let's look at their earnings right now. Their earnings estimates, if we look at these numbers and these numbers, it seems like they're growing 8.5% between this year and next year, and then 18%, 16%, and 4%. That's not very consistent. So this is the kind of stock I would watch. Right now, if you kind of average these out, they're growing around 14%. And their PE is at 14, their forward PE is at 14, so their PEG ratio is around 1. So so we have let me see, we have a massive upgrade cycle coming up with all PC manufacturers. That'll help Best Buy also. But let me see. I don't know, this is pretty inconsistent for me. This growth rates, 4% for 3 years from now and only 8%. But they do have a tailwind of these AI servers that they're building out for data centers. That makes it interesting, but I'd wait for this to like sell off in a massive sell off in the stock market before I would look at it. It doesn't seem that exciting to me right now. If you look at their statistics, their profit margin isn't that great. It's at 4%. We want at least 13% in the stock we're watching, and return on equity wasn't even calculated. The PEG ratio is 41.47, so it seems like it's 1.5 times overvalued. So if you divide the price of the stock by 1.5, you'll get what it should be really trading at. All right. Okay, so I did a stock screen. I do this every week, but this week I sorted by free cash flow. There's some famous investors that have been saying that free cash flow is the first thing you should look at and make sure that the company that you have in your portfolio has free cash flow, because that is very important. It's hard to fake free cash flow, and it is very valuable, especially whenever interest rates are high, like right now. So right now I highlighted some, we know Google is the highest free cash flow in the stock market. I also highlighted T-Mobile and MasterCard, which we're following. But there are some other ones that these are ones I'm highlighting because we'll wait for them to sell off before we look at them. They're a little bit expensive right now. They're like 1.24 PEG ratio and 1.36 for Taiwan Semiconductor and American Express. So these are stocks I'm going to put on my watch list. And whenever we have a sell-off, I'm going to start looking at some of these stocks with high cash flow and see if they make any sense. One stock that fell on this list was Energy Transfer. They're a company that transfers in pipelines natural gas, liquid natural gas. So I thought it'd be interesting to look at that. We also had an article about that this week. The other stocks that I thought were interesting, one was Tenet Healthcare. It says it's half price. Tenet Healthcare is a hospital company that runs hospitals and clinics. And I highlighted some other ones, but a lot of these are, they have higher PEG ratios, like like 2 times overvalued. But sometimes when the stock market sells off, you can start looking at these and they might be fully valued or undervalued. We looked at Progressive last week. It seems like it's half off. There's an article that came out today about insurance rates in California that are like going up like gangbusters. So everyone has higher insurance rates, and that's a tailwind for these insurance companies. And it's a good way to diversify, I think. Okay, so billionaire Lee Cooperman says the stock market is expensive. He thinks that, and he likes this energy transfer, ET. He thinks that's cheap. That's one we just found in our scanner. It says it's 5% undervalued in Fidelity. So I thought it'd be interesting to look at that. The dividend yield, this is like a lot of the pipeline companies, the companies that transport natural gas and oil, um, they're like REITs. They have a very high yield, and usually they don't have a whole lot of a growth to their stock. But this one yields 8%. And the rule of 72 is you divide 72 by 8, the yield, and that will tell you how long it'll take, how many years it'll take to double your investment. So that'll be 9 years. If you hold this stock for 9 years and it doesn't go out of business, you will double your money. But you can see it's a pretty, it's a stock that has pretty wild rides in general. You can see it's going up and down and up and down, but it's been going pretty steady for the past year or so. It's been steady in an uptrend. If you see this uptrend, it's like almost a perfect uptrend. So energy transfer, you see the forward PE is around 10. That's pretty low. The PEG ratio is 0.5 according to Yahoo. That means Yahoo thinks they're growing at 20%. And the profit margin is half of what we're looking for. We're looking for around 10. And their return on equity is 14. That is acceptable. The one issue with this company is their debt is 58 billion and their market cap is 54 billion. So they have a major problem with debt. So any conference calls you listen to for this company, you have to make sure that they talk about servicing this debt and reducing that debt level, because that is the major problem with this company. I try to avoid buying companies that have high debt levels because it's just a drag on their earnings. So I did a quick research of their growth rates, and it seems like they're growing about 20% if you average all these out. Their PE is 10, so they're about half price. So the warts, or they have a lot of debt. They might have had to acquire some stocks to get that to where they are. But right now, their dividend is 8%. So it's a 28% total return. So they missed their earnings estimates, you know, more than they've hit their earnings estimates. So the red on here means they've missed. So that's not that great. The high debt load isn't that great, but they're going to be helped by lower interest rates as the Fed reduces interest rates. So it seems like this is not that consistent for me. Maybe whenever there's a stock market crash, I might look at it because it's yielding 8% now. If it crashed, then it'd probably be yielding like 12%, and it's growing. It'd be a little bit more better of a buy, but not right now. It seems like there's too many iffy things in too many red flags. Anyways, that was a good little excursion. Okay, Tenet Healthcare is the other one. If we look at our Fidelity chart, we see it's, according to Fidelity, they said it's half off, a PEG ratio of 0.58. That's very interesting. And Fidelity says they're growing around 10%. And that's what we know from Fidelity's. So let's look into that. Tenet Healthcare, they're a hospital company. They make hospitals. I mean, they run hospitals and clinics related services. So they're growing around 20%. It's inconsistent growth. You can see it's 51, 7, 10, 11, and 20. So that's not that consistent. I like to have a consistent, at least a consistent 11% growth. So they're growing around 20%. Their PE is 18. So the PEG ratio is a 1:1. I'm not sure where Fidelity got 0.5 for their PEG ratio. So let me see. They have a high debt load also. So a lot of times you have these screeners, you have to really look into it. They're on sale for a reason. They're selling for a lower PEG ratio than the other stocks, but you pay more for a car that starts in the morning. So this stock, Tenet Healthcare, let's look at its debt. Its debt is 12.8 billion and their market cap is 15.7 billion. So that's almost equal to their market cap. That is a lot of debt. So the theme of this company should be pay off the debt and as you grow the company. So right now, this PEG ratio of 1 with a lot of debt, but they're beating their estimates every time. I see a lot of green here. That means they're meeting estimates. That's why the stock is probably up, this consistent 12 quarters of beating estimates. Let me see. Lower interest rates will help that debt load when they refinance. And there's momentum in the stock right now. It's going up. All right. So for me, it's not that exciting of a industry. Healthcare, with a PEG ratio of 1. If I saw this at half the price it's at right now, I'd look at it. But it's just not a consistently growing stock. Not good enough for me. All right, but that was a good little research. You can see their stock is super good performing. It's in an uptrend here for the last year. So it must be because of all these good earnings reports. They've actually, from last year to this year, they've grown their earnings 51%. I don't know the number why that happened, but seems like an outlier. They seem to be going back to a 7 to 10% growth after this year. Okay, so all right, that was an excellent talk. All right, I think that's all I have for today. I hope you enjoyed the talk. I hope that you have a good investing week in the coming week and have a good Labor Day holiday, and I'll see you next time.